Ladies and gentlemen of the crypto space, we're live on a Friday, August 18th at 12:03 p.m. Title of the stream is Global Puppeteering. This is a contrived system. It's an artificial system. It's a constructed system filled with collusion, organization of individual actors, and obviously the sovereigns at the highest of levels. To do what? To manage a system that obviously at least works, at best achieves their particular objectives, and overall, first and foremost, the primary objective is social civility. And obviously, humanity has decided that governments are trying to maintain productivity and moving everything forward. And in many regards, it does work uh, to a degree based on consensus. The World Economic Forum and large organizations as such, there's consensus amongst many human beings around the world on how folks think is best to move forward, and the general is probably a disconnect in many regards. That's obviously the case between what the general public thinks how we should move forward versus how these centralized organizations think we should move forward. But are they really centralized? How many people are involved with these organizations? So it's complicated in that regard, and that's not necessarily the point I'm trying to make. Probably the most specific point I'm trying to make: puppeteering. It's a contrived system. So we know long term things that will have to be done, and this is basically what I've been saying for a long time now, that the destination is clear, very clear. It's the short term that it is not so clear. I fix my green screen so I don't look so silly. Oh, hello. So Joseph talks a lot, and I just found this, and I was like, all right, that's cool. It's just a quick little snippet into how contrived the system is. They're trying to meet their policy objectives with regard to consumer price inflation. And it's an entire conversation whether this is effective at achieving those ends or not. But obviously, Treasury has a capacity to issue more or less collateral into the system. The Fed has a capacity to be a buyer or seller of collateral as per their balance sheet. So they could influence circulating supply. And I don't, nowadays, I've simplified the whole QE/QT equation. They're just a buyer in the market. And when they become a buyer, everyone wants to front run the buyer because they know a buyer's in the market. And they're going to buy before the big buyer, so they're going to be in prior to the big actor basically deterministically buying according to whatever policy they set. So that's the super duper simplification of QE and QT. It's just a large actor in the market that's going to be buying and selling uh, based on expectation. And that makes it really easy to front run. So everything being puppeteered, they've been draining the system of collateral. I've always, in recent streams, probably the last 50, we've been saying the destination is down. The pressure is deflation of global currency supply. You can inspect it more granularly from like a Mike Howell perspective when he talks about global liquidity composition. And the net composition at the overall global level has been relatively stable for the vast majority of 2023, hence price action in markets that are dependent on availability of liquidity. But now that you have spillover from China's very horrible state of its real estate sector, they're exporting that deflation and negatively affecting the composition of global liquidity, forcing people to sell. What was the headline? SpaceX sold their Bitcoin. Whether that's specifically the case or not is irrelevant. The title itself is interesting. That's a forced sale. They needed to sell because they needed that liquidity for whatever reason. And if you think that's the most important takeaway from such a story, don't be short-sighted. That'll happen across the board. At some point, everything not nailed down is going to be sold because you need the liquidity to survive when existential threat is seen or glimpsed or maybe even smelled or sniffed on the horizon. And then we've seen that time and time again. Nothing of recent events or this event or anything that could potentially come between now and the next 2 years changes the destination unless there's an extraordinary display of a very contrived um, uh, desire to puppeteer an outcome. So the only way the current system, and that's all the information we could really go on, the only way for the current system to continue to work is a significant increase in liquidity into the future. Otherwise, this deflationary trajectory is going to force liquidate, and that creates a cascade because forced liquidation is exactly what you saw in the crypto markets, begets more forced liquidation, hit the stop losses, causes depreciation, someone else is forced to sell. And the thing is, when that happens at a global level, it's like watching a celestial event where it takes months to play out and the forced selling cascades over months and months and months. So that's the trajectory. So the only reason this trajectory persists is financial repression to balance supply and demand, to create that politically favorable narrative that policy has been engaged to curb consumer price inflation, which is the case. If you want less people buying goods and services, you need to cause capital destruction, which is bankruptcy and insolvency and poverty and unemployment. That just makes sense. If you have 10 goods and 12 people are searching for 10 goods, that's out of balance. What you need to do is make 3 of those 12 people not capable of searching for the 10 goods. And then the prices will stabilize. And if you do that long enough, the prices will come down. And if the prices come down, that's not necessarily a good trajectory. And that's exactly why the Fed's CPI target is a positive number. It's not zero. It's not negative. You need that expansion, that growth, that capital expansion. That's the current system. If you want, don't be deluded and drink too much of the Bitcoin narrative that inflation is necessarily bad. It's a very complicated story. But in the current regime, inflation is not bad. Too much inflation is painful. But there's a lot of moving sprockets in that statement. Deflation is bad. Deflation will cause a collapse of the current system. And lack of inflation not even deflation will cause a collapse of the current system. And obviously we could curse that to all end the wage price increases and what they talk about in mainstream media, the wage price spiral. And that's the general public wanting more money, and they should want more money to not accommodate inflation. They should want more money because they want to escalate their career and their lifestyle. So that's a whole broken conversation that we don't have to entertain at this point. Suffice it to say, I strongly encourage everyone to not necessarily just subscribe to what people define as bad, but to understand these talking points as pressures in the system. Inflation, disinflation, deflation. Don't put bias on them. Don't put prevailing rhetoric or prevailing stereotypes on these pressures. The most important thing is to understand them. Because when you understand the system, which is the description of today's stream, that's how you find your comfort zone. And the only way you can navigate these markets is to be like, oh, I understand what's going on. Oh, I'm comfortable. I made the right choices. I have a methodology, which I see no reason to adjust how I am engaging with markets. I have reduced the equation to a very traditional methodology for engaging with markets. I've simplified the equation. And nothing about any price action can change that unless there's an invalidation of a narrative. And if a narrative invalidates, that's the reason to exit a position. And then you have the question that you must consider. If you cannot exit a position, then you can't do anything. So that simplifies the equation. If you cannot do something, you've simplified the equation. So that's the entire construction of my portfolio, just centered around the notion of simplifying the equation so I can engage with life and not have to think about the enormous, unending complexities of capital management. How do I simplify the equation? How do I have a simple way of engaging with markets that is repeatable and consistent, and I don't have to adjust to volatility, even if it's unexpected volatility. But as of this point, are we really not expecting more volatility? Up and down and left and right? I expect significant volatility. There's no such thing as up-only mode on the horizon. If anything, up-only mode is a result of a deflationary cascade where they have to intervene, and you see emergency quantitative easing of $500 billion a month this time around. Whatever they were doing in 2020 and 21, that was small compared to what they would have to do to control the volatility across the systems that they control, which is not what everyone thinks. Fed has a capacity to influence the bond market. And Treasury, obviously, they could increase liquidity in the bond market, and Treasury wants to get into that game as well. In 2024, they'll be decreasing liquidity in the bond market. So, excuse me, the Fed and the Treasury both have levers to influence the bond market. They have very little control over the currency market, over dollar liabilities, which is something that most don't hear about, but that is the case. Vast majority of global dollars have nothing whatsoever to do with the Fed. Obviously, when you influence the collateral markets, it's a knock-on effect to influence global currency markets, but it's not directly controlled. It's not like the Fed is buying dollars. They have a capacity to print dollars by creating liabilities or borrowing against collateral and stuff like that, and that's the Fed shell game. But that's only a small subset of the amount of dollars that have been printed globally. Dollar liabilities in the Eurodollar system, which we've been talking about for years at this point. So understand these things and understand that the destination is not changing. The only way, if you're nosediving with regard to liquidity and deflationary pressures, and you see the cascade everywhere between commercial real estate and student loan repayments starting, and whatever the hell's happening in China cascading, if the debt implodes, which it already did, Evergrande filed bankruptcy, and was it China Supermarket or whatever their other property managers called the big one. If they don't pay their debt, then who used their debt around the world? I'm sure that debt was used in a lot of places around the world to print dollars, to extend credit, or to collateralize, to receive credit in the form of dollar liabilities, which the global banking system supports. In the absence of paper dollars, you can print liabilities of dollars. And that's just as good as paper currency pretty much around the world. So how do you, if the trajectory is downward, how do you pull the trajectory up? It's the cycle. You loosen policy such that credit is more likely to be extended. And that would be a bull steepener where the short end of the bond yield curve gets bought. And now short end is less interest than the long end. The bear steepener is where the long end is increasing in interest rates, inverting the yield curve from the long end. If you uninvert the yield curve from the short end, that's the bullish case, and that's the Fed basically controls the short end of the bond yield curve with their Fed funds rate. So to pull out of the deflationary trajectory, they need to encourage via arbitrage, which is their primary facility, increase liquidity conditions around the world. My speculation is that when they need to start to increase or support liquidity around the world, it will be much more, have much more pressure, have much more, it will require much more effort than it has historically, and that's a result of a very physical phenomena called resonance. The trajectory of deflationary pressure is much more than it has been in the previous cycles. And as I describe, using resonance for comparison, the cycles are getting bigger troughs and bigger peaks. It goes up more and it goes down more. So that's my expectation. I I want to see this market when it's at the bottom, because when it comes time for those liquidity conditions to improve, it's going to be quite an interesting ride up as compared to what we've seen in about 3 or 4 cycles over the last 15 years. And that brings us back to, is it an organic market? Are they going to be able to intervene? Even if they're not able to intervene and achieve their objectives, intervention is destined, because one objective always, whether it's to the extent of what they want to achieve, is survival, is the maintenance of the status quo, the continuity of the status quo. So if the treasury market ceases, best believe they're going to be the buyer or the seller of last resort, such that there is a market and you don't have civil unrest and ATMs that don't have paper currency, or 50% of the U.S. banking system collapses because HTM portfolios just are become useless. If bonds go down another 20%, it's going to take a good part of the entire banking system with them. And that's where we are. That's where we are, ladies and gentlemen. Look at this chart on the 30-year. It's been an entire year. It was October of 22 where we were last at these highs, and it's not the highs like, all right, this the last time we were here was October 11th. It's the structure. The structure is broken. We're almost August, September, October. We're 10 months out of the last time we were at this yield, confirming, validating this structural breach. We've never, since the beginning of this chart, 87, this is the 30-year, we breached the TWAP. This is the first time ever, last year. And now we have a candle that can easily close above the TWAP. You know, it'd be interesting to see, as I've said many a times, and I will continue to say, higher lows. What if you hold the TWAP as support? And look where these lines are drawn. This is the yearly chart. So, you know, into sometime this year, Q1, Q2 next year, some crazy risk off happens, and you know they buy bonds just because it's a possible path, a possible trajectory, but they get down to 3%. And then into 26 and 27, you start to breach new higher highs on yields. This is possible. No one would have ever thought this was possible many years ago, or just even several years ago. But it breached the TWAP. That's why moving averages are so meaningful. Moving averages aren't just lines in a chart. This is a manifestation of the aggregate market, or the participants in the market on average, the composite man, so to speak. So the technical analysis is meaningful. It tells a story about what people think and believe and feel on average, and they take actions based on those perceptions. And the price action is a knock-on effect of their sentiment, of how they're interpreting the structural change in the global financial system. So this is where we are. Let's take a look at the dollar real quick. Look at that damn 10. You know how we've been talking about the 6-month chart on the dollar for a bit, and especially the magical 103 number. Let's go out to the 6-month. Give some granularity compared to the yearly. Look at that 103. Look at that damn 103. Woo! I don't want that. I want to delete that. There we go. Oh, come on. Delete. Give me a pointer. Oh, I don't want to move that. I just want to move this. And I want to move this. Okay. Had 103 line. That's crazy. What are they doing? This is the ultimate chart of global collusion. The only way this chart goes down is if the powers that be coordinate for it to go down. Otherwise, as Brent Johnson, do I have his tweet? I think I just recently retweeted it. Yeah. World can't de-dollarize without deleveraging. If you don't deleverage, shit blows up. People don't get paid. People don't have capital to do anything. And that's not just people, that's businesses and enterprise. You can't deleverage without deflation. And deflation is the pain. There's a different pain with deflation as compared to inflation. Inflation is the invisible tax. Deflation is just frickin' collapse. It's where there is no food at the damn grocery store because they couldn't get net 30, net 90 to actually pay people to drive trucks and stock shelves. And there's no, you don't know, they couldn't pay the power company to turn the lights in the freezers. That's deflation. It's a different type of pain. System can't survive deflation because debt-based and must grow or die. So there's your destination. They're trying to deflate. So from a time horizon perspective, we're in a state of deflation on a relatively shorter lens of inspection. On the larger lens of inspection, obviously we've inflated significantly as compared to like a 2008. But on the short term, even if you just look at USM2 to get a sense of deflation, that's what they're trying to do. Those are the pressures in the system. And those pressures from a U.S. policy standpoint obviously have been counteracted by policy of China and Japan. And now that shit is not necessarily working, which is why you have deflationary pressures from a global liquidity perspective. When a debt-based system deflates, underlying collateral rises. Why? Because how are you going to pay things back? You pay things back by buying dollars. And how do you buy dollars if you're in another country? You use that fiat from another country to buy dollars to pay back dollar-denominated debts. Underlying collateral of system is the dollar. Because bonds are future dollars. That's what he means by that statement. So it's all the dollar. Whether it's present dollars, future dollars, dollar liabilities, is dollar, dollar, dollar written everywhere. So he's obviously talking about the prevailing narrative of de-dollarization, which is not even remotely reasonable without complete civil unrest, not just in smaller, untalked about countries, and that's not to diminish or marginalize the significance of every human in every country, no matter the size of the country, but that's civil unrest in the big major countries, European countries, China, Japan, Korea, Philippines. Mess. You can't de-dollarize. The deflation will not be accepted. So the inflation is not accepted from a policy perspective. The politicians are obviously, their rhetoric is we can't have inflation, but they could kind of say they're doing something about inflation, which they are. They're causing intentional deflationary pressures. But when deflation is on the table, that's different than measures to fight deflation. When deflation is on the table, it cascades. And that's what happened in 2008. Everything froze, collateral froze, debt markets froze. That's what happened in 2019. September 2019, the United States banking system failed. There was no lending. If you can't lend from one bank to another, there's no way to balance the books. And if you just sent money from Wells Fargo to Chase, how do you balance the books? If the capital wasn't being lent from one bank to another, how do you balance the books? It fails. Transactions don't get through. All of a sudden, they build up, and you know how shitty the status quo transaction system is, and if they need to go through. If they don't go through, people get angry, people get pissed, and it all leads to civil unrest and basically shit not working. Anyway, Critical Mass in the house. Tim Khan's in the house. Kazika, hey, no, I hope you're good. No time to watch this. It'll be here when you have time. Thanks for the didn't see, and quality content. I hope it does. It helps me. We've gotten to where we are because we have these conversations to have a more comfortable perspective on why the markets are doing what they're doing at any given time. Can you do me a favor and just have a quick view of what BitSensor does after streaming? I think, what is BitSensor? 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 Well, I'm not going to dig too much on stream, but security? BitSensor? Security is important. I don't know. It's not really something that this is not necessarily the time for new. I don't even know if I'm looking at the right thing. Very light social media. Be careful in this market. Tapsies in the house. Ask Smith. 19 people in the stream. 6 likes. Hit that thumbs up button. I appreciate all of you. Let's take a look at Bitcoin. 6 month is too far. We'll go back to it in a second. Look at the TWAP. Nothing has changed with the TWAP. If you bought in earlier, 17, 18, 19, 20 at times. So nobody's really thinking. Then this is the multi-year time frame. So what do you think things are going to be like in a couple of years? Does it go down from here? This is really a proxy in many regards for global liquidity because the dollars that come into this have nothing to do with necessarily the dollars that are just created in the United States. We're talking about composition of global liquidity, which are many denominations, and the vast majority of currency is not in the United States, nor is the vast majority of currency printed in the United States. It's printed outside the United States. And what did the United States just do? They printed, or are still printing until end of fiscal 2023, a tremendous amount of debt to roll over the debt. I wish I could find that chart. Let me see if I can find it real quick. Santiago. It might be a ways back from now, and he posts a fair bit. It's a chart of the debt maturation. It's a great talking point. Oh, he's been busy, just like me. We're always so busy. Oh, come on. So the vast majority of debt maturation here. Yes. Look at this. This is a great chart. This is maturation in 2023. 30. I don't know the scale. That wasn't the point of his post. What's very great, a great takeaway from this is such a huge amount of debt is maturing in 2023, and they just printed a huge amount of treasuries to cover that debt. Then look at everything for the next 2032. Oh my God, that's 6, 7, 8 years of a significant reduction in the amount of treasury issuance, depending on fiscal. So fiscal until 2025, I think they capped it. They're not allowed to increase fiscal expenditure. Obviously, anything on the books, they're financing. But look at the reduction in the amount of maturation. And look at the amount of treasuries they just issued. Fresh off-the-run treasuries. Fresh on-the-run treasuries. So the collateral composition there's a great pressure now or of supply for international offshore printing of dollars. So we're witnessing the precursor, the steps required for when the cycle reverses to the upside for conditions that are significantly more favorable for liquidity expansion. Fresh collateral just entered the system. The largest amount of off-the-run treasury, stuff that's already in circulation, matured, and now these are fresh paper. That changes the equation with regard to rehypothecation and the capacity for the offshore printer to really start moving, get its engines roaring. So 2023 is going to be tight. But when the cycle comes in, Q2 2024, 2025, whenever it comes, cycles will cycle. And I want to be here when this cycle bottoms. I don't give a crap if it's another 50% down. I don't care. I want to see it. And I'll pay to see it. Because I want to see when the cycle starts going up. I'm freaking excited to see it. Tapsy asked Smith, I hit you guys. This was a good point. Let's go back to the charts and see anything interesting. So, structurally, from a log chart perspective, obviously turn that off. Can I? Nope, that's the wrong one. Here it is. You can turn that off to get, a more fair perspective, but the log chart does what it's supposed to do. Anyone who bought in past, anyone who bought before 2020 is in a very nice spot. So that's pretty good for a cash position. So as we've discussed, redefine the usefulness of assets. I will not define Bitcoin or Ethereum as an investment and manage the composition of your cash position. And obviously that changes over time. So for me, I bought some Ethereum yesterday in the 1500s. Went down to the 1400s, but I couldn't snag in the 14s. But I was able to get it in the 15s, and that was nice. And it was just an adjustment of the cash position. All that is cash. I have investments, so this is my portfolio mentality to simplify everything. I have investments that produce cash flow, and that cash flow I denominate sometimes in stable coins and dollars in a bank account, and sometimes I pay things. Other times I rarely reinvest nowadays. Maybe two investments this year, I believe, or was Aura last year? I don't remember when we did Aura. It was either the beginning of this year, but Nolo was a very small position this year. That thing is very volatile to say the least. I think we have it up here, but this is an interesting one. And those are the only positions I've done this year. So reinvestment is not on my radar. And I don't consider Ethereum an investment. It's just a composition of the cash position. If I need cash, I have it. If it's in one denomination or another, it could be in euros, it could be in pounds, it could be in yen for all. It's whatever. Maybe you even consider diversification of the cash position. Some people play forex and they do consider different denominations of cash as an investment. So that's obviously not my story or not how I engage with markets. It's something to understand, and you choose. You can choose to define Ethereum or Bitcoin as an investment or not, but I choose not to. I like the way these charts look. That was a very large sell-off, and it hit the 50 SMA in the monthly. Right smack into it, and it was all bought right above the TWAP. So this chart, from a monthly perspective, 13 days left in the month. Obviously, we have to see what the rest of the year has in store, but thus far, what is this chart? This chart is a breakout and a retest. And we're waiting to see if that retest turns previous resistance into support. And then you want to see the higher high for the trifecta of bullish confluence. You want to see the higher high. So, see that November, December, Q1 2024. Or even higher, you want to see the higher high. So when you see like Ethereum at 2200, you're breaching the higher highs after a breakout, a retest, and a confirmed hold of a resistance flip to support. So looks like a very nice chart. In fact, Ethereum looks a little bit more favorable as compared to Bitcoin from a moving average standpoint. Well, Bitcoin is significantly above the monthly TWAP, the 10 SMA. It pushed below the 50 SMA, and Ethereum held support on the 50 SMA is pushing back. It's kind of a different moving average structure. So it's very similar. But I like the wick. I like to see the wick as compared to Bitcoin just being literally at the bottom. It's just got a big old hammer going on right now. If we zoom in. I'm not fond of it just sitting there, so I'm more fond of this wick occurring. It's nicer, more comforting. Got to find the comfort zone. So I'll wait till the end of the month. That's going to be interesting. All right, let's look at curve. 50 cents. So fun fact, yesterday's breach to the downside was fair amount lower than what occurred a couple weeks back. A couple weeks back, we got the 48, we got the 46. How about them apples? I know a lot of people out there bought. That's cool. That's cool. I didn't do anything. The extent of what I did was just recomposition of the cash position. Total three. Total market cap excluding Bitcoin and Ethereum. Below moving averages. Bearish from a moving average standpoint. Let's zoom out to the monthly. Bearish from a moving average standpoint, but a higher low as compared to whatever capitulations happened in June. Higher low as compared to January and December of 22, January of 23. Clearly, it's higher lows as compared to 2017 to 2020. So that's why we zoom out nowadays to stuff like the 6 months and even the yearly. But you don't get that kind of interesting picture on the crypto markets because there's just too little data to go on. But that's why we look to markets that have significantly more data that are the forward-looking indicators on directionality in risk markets, especially crypto markets, which are basically a proxy for global liquidity. And then if you go over to move, this is interesting from a 2023 perspective. From right now, this is still an extremely elevated level, and this is a level that's going to be restrictive of offshore dollar printing. Yes, you see this fall to the 70s? That means they finally got volatility in the collateral markets under control, and that'll be a foreshadow, a relatively quick move works relatively quick as a foreshadow on improving global liquidity conditions. That's why this is such a meaningful chart to look at. A little more granularity on the monthly. It's like a 20-month rolling top after a blow-off top in March of 22. Cycles will cycle. This has to come down at some point. It could be in 2027 for all I know, but the point is, I want to be here when it starts to come down. 121, I would love to see this below the 200 monthly, 50 on the monthly. Yeah, below the 100 on the monthly, and shit's going to start to get wild. You're going to see, if you see this on below the 100 on the monthly, you're going to see behavior like in 2020, summer 2020. It's just going to just be like a frenzy. The liquidity, whatever causes it, but it's going to be pretty wild if you see that. Similar with the DXY. If you see Japan and China get their act in order and figure out how to kick the can another couple of years, you can push down easily below 100 for a period of time. You know, whether it's a super cycle play like I've talked about in the past, I won't digress too much. We'll wrap it up in a second. But if we see like 10, 15 years of dollar depreciation, I'm still firmly in Brent Johnson camp that this chart just wants to go up. And that's the end game for the entire scenario is just up. So every time they kick the can, the question is how long they kick the can for. And this is a chart of global collusions, there's coordination between sovereign nations to actually make it go down by a manipulation from a central bank and not even the central bank, from a fiscal, a treasury, respective sovereign nation treasury consideration and their policy choices is the only way you get this chart to go down. So if they want to kick the can, we could easily see 10 years of dollar depreciation. You see that, and the markets as we know it from a crypto perspective, global liquidity proxy, will do something unlike what we saw in previous cycles in 16, 17, and 20 and 21. These two little circles are micro blips on the dollar FX, and this bull trend from '08 until Q4 22. So we haven't seen stuff like this, stuff like down with a bounce on the 100 SMA, a retest back to 103, rolling down for a bounce on the 200, retest back to the 100 or the 50 SMA, and then a breach down below the 200, retest the 200, and you could easily see like into 36. That's 12 years. But look structurally, It's not entirely unreasonable. And these peaks and troughs right here are literally just me, you know, fast handing the extension of the moving averages. But why not? This is this is a destination where the status quo system persists for some more time, another decade, and gives them time to figure out what the hell they want to do from a global currency adjustment perspective. These large global policymakers and their level of thinking of how the system works. Do not, I'm going to end on this note, do not for a second think that you're engaging in a free market. You're not engaging in anything other than a constructed artificial video game of points, and those points are called dollars. You grow up, I'm 40 years old, and I grew up my life like, oh, how much money do you have? And that was synonymous with dollars and a bank account of dollars, and everything was dollar, 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 dollar. Just do yourself a favor and step outside the box, unplug yourself from the damn matrix for 5 seconds, and call them points. And think relative to your favorite video game that you played over the years. And realize that this is a constructed system of points and like Grand Theft Auto task objectives and pressures and incentives like tax breaks or grants or scholarships to craft a society to do what everyone has deemed is in its best interest, to grow, expand, to build infrastructure, and that's it. It's just literally a giant video game. And the more you think about the world and how you would build it, you kind of get a glimpse of what some of the big policymakers at the WEF must think when they're trying to set their policy and talk their stories and narratives. That's all it is, guys. This is just a video game at a global level that people made, and think that then hopefully that brings comfort. It surely does bring me comfort because I find a great clarity of where the destination is, because everyone doesn't want anarchy and chaos, and they kind of want to just survive, and that tells us where everything will be over a decent time horizon. Hope that helps, ladies and gentlemen. 17 people made it to the end of the stream. I appreciate all of you. In the description, links to Discord, the most rational community in the entire crypto space. I appreciate everyone that survives and wants to see the bottom, just like I do. I will pay what it takes because I want to see the bottom, and I will pay what it takes to be able to say I was there. No matter how painful it is, no matter how many people say things on social media like in it for the tech and other shit like that. No, I want to see the damn price action. I'm excited because I understand the way the global system works, the way the cycles work. And I want to see what happens when that cycle turns up. And that shit excites me. I'll see you guys again on Monday. Have a good weekend. Peace.